Today we're going to talk about the owner's drawings account. The object of starting a business is to make a profit. Owners start businesses hoping that they'll make a profit and then they can take the money out and use it for personal use. You start a business so it makes a profit. You can take money out and go on a vacation. You can take money out to buy a vehicle for yourself or your family. You can purchase more furniture. You can buy a new home. All these sorts of things are reasons why people start businesses. When this happens, when the owner takes money out of the business, it decreases the value of the owner's equity account. It's identical to any other type of expense because it decreases the owner's equity. However, it's not an expense because expenses are only recognized if the cost was used to produce revenue, according to the matching principle. When an owner takes money out of the business, he is not doing anything to produce revenue, so it cannot be considered to be an expense. That's why we have a special kind of category for this type of transaction. A withdrawal of assets is recorded in a special account called the drawings account. The drawings account is an equity account because it affects the owner's equity. It is similar to the capital account, and that's the section that it's kept in. Let's take a look at what it looks like when it's in the general ledger. We can see here that we have an example of a T account. C Piccolo Drawings is the name of the account, and we have a debit side and a credit side. Withdrawals, when owners remove funds from a business, withdrawals are recorded as debits because they decrease capital. Please remember, these are not expenses, they are equity accounts. Here's a specific example. On October the 15th, C. Piccolo, the owner, withdrew $1,000 from the business for personal use. So how do we enter this transaction in the T accounts? We go to the drawings account, and because we treat it like an expense, there's a $1,000 that has been removed from the business. This is a decrease in the equity, a decrease in the owner's equity, and so it goes on the debit side. So we have October the 15th, $1,000 on the debit side. Also, to hold true to double entry accounting, we need a credit account, and that comes from the cash account, which is where the $1,000 was taken. Regarding drawings accounts, salaries can be paid to business owners on a regular basis. And for income tax purposes, these cannot be recorded as expenses. They have to all be recorded as drawings. All salary payments must be recorded in the drawings account. This is a good time to stop and take a look at where we are now regarding all the different types of accounts and what types of reports they help to generate. First of all, we want to talk about the accounts in the general ledger balance sheet section. Here is where we have our assets, our liabilities, and the owner's equity. And now, because we've got the owner's drawings account, this also is located in this section. These are the accounts that will find themselves on the balance sheet. Now we want to take a look at accounts that are in the income statement section of the general ledger. This is where we have our revenue and our expenses. And when you put these all together, you can see that you have the parentheses on the right hand side where we can say that assets, liabilities, and owner's equity all belong on the balance sheet, and revenue and expenses belong on the income statement. Let's review the types of questions that we need to ask ourselves when dealing with transactions. When we studied transaction analysis sheets in Unit 2, you were given some types of questions to ask yourself in order to determine how we're going to deal with these transactions. One question we have to ask ourselves is what accounts are affected? Then we have to ask ourselves, were the accounts assets, liabilities, owner's equity, revenue, and expense accounts? Now this is different from what we did in Unit 2. We only had assets, liabilities, and owner's equity. But now we have to consider revenue and expenses. Now we ask ourselves, did the accounts increase or decrease? And were the accounts debited or credited? Now that we know all the rules of the debits and credits, we should be able to analyze these transactions using these questions in order to make the transaction accurate. Your assignment for today is to complete exercises 9, 10, and 11 on page 91 and 92 in your textbook. Use your workbooks to record these answers.